Hi, I'm Patrick Ritchie, and in today's webinar, we're going to talk about mortgage overlays. One lender says no, another says yes. Why does that happen? Well, first of all, what is an overlay? An overlay is when a lender has a requirement above and beyond the actual mortgage guideline. So whether it's FHA, VA, USDA, your conventional Fannie and Freddie Mae loans, it's when there's a specific guideline but a lender decides to enhance it or be more conservative. That's what an overlay is. So why would they do that? Well, the main reason is to lower risk. If there's a guideline that you can take some risk out of by increasing your stance on that guideline, you're just lowering your risk. So that's the main reason why, and it varies from lender to lender. The reason that you want to know about overlays is because it's very possible that a loan could be denied at one institution that could actually be done at another. And so it's really important to recognize that and know, okay, we need to not give up. We might get 2 or 3 no's on this, but the 4th or 5th attempt could be a yes. So it's really important to kind of familiarize yourself with what the overlays are, what the standard typical overlays might be. And a lot of times it's going to be credit scores. Example. What is the minimum FICO score for an FHA minimum down payment? So to get the maximum FHA financing, what is the actual minimum FHA FICO score required by HUD or FHA? And I hear a lot of different answers in classes. So here's the most common. Sometimes I hear 660. Sometimes I hear 640. Sometimes I hear 620. And sometimes I hear 600. So you're talking about a 60-point spread that real estate agents in the market are thinking or being told or seeing on flyers, 600 to 660, that the minimum FICO score requirement for FHA is, when in fact the answer is 580. Now, I'd say probably 10% of a classroom get the 580 correct. But that means that 90% of people out there are thinking it's 600, 620, 640, 660. So that's going to vary from lender to lender. And the lower a FICO score goes, you get under 640 on the FICO score, and you're going to start seeing some requirements, especially when you get below 620. You might have some requirements to where there's just no way that borrower is going to meet it. Maybe you've got to have 6 months reserves that they're not going to have. Maybe they do, though. Some people will meet that. Maybe you start to have debt to income ratio caps, all sorts of things. Another example of an overlay, besides just the FICO score, might be how high somebody can go on a debt to income ratio. Even if an automated underwriting approval goes, at a certain level, let's say it goes at 51%, but the lender says, no, we don't go over 50 or we don't go over 45. That's a possibility as well. But this 580, where does this answer come from? So what's the source? You always need to know what your source is, and the source for that answer is going to be the 4155. If you're not familiar with the 4155, that is the HUD handbook for FHA guidelines. And so in 4155.1 in section 4A1C, it talks about the FICO score. What are the requirements for FHA in terms of doing maximum financing, which would be 96.5% LTV. That's your 3.5. That's your standard. If I want to put the least amount of money down on FHA, I'm putting 3.5% down, and that's where you have that 580 requirement. Now, you'll have potentially some down payment assistance programs that could have a higher requirement on the FICO score, and that's not a lender overlay. That would be a program overlay for that down payment assistance. And that 3.5% also includes not only somebody's down payment that they've saved up, but also could be a gift. And because a lot of times people do use a gift with FHA, but the guideline says 580. So that's your actual answer there. And then, so we know 580 is for the maximum financing. But what if somebody's putting more down than the 3.5? What if somebody's going to put more money down? Could they have a lower FICO score? Well, the answer is yes. If they're doing 10% or more down, so if they're going to be at 90% or less on the loan to value, they could go all the way down to 500. So you could be at a FICO score of 500 to 579 when you're putting 10% or more down on an FHA loan. Now, whether or not a lender would go with that, that's up to the lender. But you need to know what the actual guidelines are if you are ever in that situation with a client where they're, qualified otherwise and they have these scores. Now, what are the situations where somebody, because generally if somebody has scores like this, the credits, there's a reason, like there's a lot of recent late payments or collections. But what about divorce situations? And I see this a lot where somebody goes through a divorce, they have some joint debts that were assigned to their now ex-spouse. Those debts aren't paid on time, and then it hurts this innocent spouse. That's where you get somebody who's in the 500 range, but it's not necessarily their doing, it's that their ex-spouse isn't paying joint debts that were assigned to them. So that's just one example, but it is possible. You can go all the way down to 500, and you could also have no FICO score at all. FHA will do non-traditional credit guidelines where you're using alternative credit, and they've got some different tiers on that where you show I've paid rent on time, I've paid my utilities on time, I've paid my car insurance on time, I've paid daycare, whatever it is. They have a whole list of different acceptable alternative credit sources. This is for when somebody has no FICO score at all. So if they have a FICO score, the non-traditional credit guidelines would not apply. But if you do have somebody who has no FICO score whatsoever, I would say a lot of lenders wouldn't do that loan because of the overlay that they probably have of, well, if you don't have a FICO score, I'm sorry, we can't do a loan for you. But it does exist under FHA. It's in the guidelines. So you just have to find a lender that would actually do the no FICO score non-traditional credit guidelines. What about the conventional guideline on how many financed properties that a person can have? I hear this in classes all the time where people are like, oh, well, you can only have 4. Some people say, well, you can have 10. And they're partially right. It just depends on the situation. But the reality is if it's a Fannie Mae, I'm using Fannie Mae guidelines here. I'd have to double check, see what Freddie Mac's guidelines are. But usually they're fairly similar, sometimes different. But on Fannie Mae specifically, there's actually no limit if they're financing a primary residence that's going to be delivered to Fannie Mae. So if they're buying a new primary residence, well, based on the guidelines as of December 31st, 2014, the guidelines say there is no limit there. But if you're doing a second home or an investment property, there's 2 tiers. The first tier is 1 to 4 finance properties, and then the second tier is 5 to 10. And it just is going to be a difference of different requirements. It could be a basis of what is the equity position, reserve requirements, stuff like that. And you could have some hits to the interest rate as well. If somebody's at 5 to 10 properties currently financed, obviously there's some more risk there. They've got a large financial commitment, and they're, as far as how they're managing it, all of these things. So there could be a hit to the interest rate. It could be a hit to mortgage insurance rate, stuff like that. So the general answer, though, would be up to 10. But it is possible that it could be considered unlimited if they are getting a primary residence. So things like this, using business assets, can you use that as a down payment? Some lenders say yes, some lenders say no. Well, you can. It just depends on the appetite that lender has. What about somebody starting a new job and they haven't started yet, they haven't received a first pay stub yet? Can that loan be closed on Fannie Mae? Well, it can be if that lender will close it and then just lock it and hold it through the start date and the date that borrower is going to get their first pay stub. They could do that. Will every lender do that? Some will, some will not. So if you've got somebody in that situation, you need to find a lender who would be willing to do that, where they're going to just hold the loan and have it locked, fund it, and then get the first pay stub and then deliver it to Fannie Mae. So you're going to have variations there. So up to 10 finance properties for a second home or investment. So the bottom line, the whole purpose of this webinar is that if a loan is denied, if a mortgage is denied, it may be possible that there is still hope if it was a situation where this person is just falling victim to an overlay for an individual lender and not necessarily the overall guidelines for a program. So it just depends on what's going on there exactly. But just keep in mind, just because one lender says no doesn't mean that another won't say yes. And beyond just the overlays, it's so important to work with somebody who knows their guidelines, that reads their guidelines, that stays up to date on their guidelines. Because I have had so many people who have said, well, you can't do that because of this. And then I'll look at them, I'll say, well, the guideline says you can. Like, here's an example. I had somebody in class where they had a veteran who wanted to buy. Well, the lender told the veteran and the realtor that he couldn't buy because he wasn't going to be able to occupy the property within 60 days. And that is a guideline for VA, unless you have to occupy within 60 days, unless you're active duty currently. If you're currently active duty, you have up to 12 months to occupy that. So he was active duty. He was going to be able to occupy it within less than 12 months. So he was actually eligible for a VA loan, but the lender told him that he wasn't. So I'm not sure if that was a case of an overlay or if that was just a case of somebody not knowing their guidelines, but here's somebody being told that they can't do something that in fact they can. So it's important, I believe, for the real estate industry to have some understanding of what these guidelines actually are, because in the end, it's going to help you help more people. So I hope you enjoyed this particular segment. Join us next time. And if you have any questions, you can always go to creditliteracyproject.com, see more information about credit and mortgages and finance. And I hope to see you in the next webinar.